My name is Alex Morgan. I have spent the last 12 years tracking commodity markets, precious metals, industrial metals, energy, and I have never seen a market behave quite like silver is behaving right now. Not gold, not copper, not oil, silver. And if you are not paying close attention to what is unfolding in this market today, I want you to stop whatever you are doing and watch this video from start to finish, because what I am about to show you could be one of the most important setups you see this entire year. Here is the situation. As of this morning, February 25th, 2026, silver is trading at $87.72 per troy ounce. That number on its own sounds big, but the story behind it is even bigger. Just 4 weeks ago, silver hit a nominal all-time high of $121.67 on January 29th. Then, in a move that shocked even veteran traders, it crashed 27% in a single day, briefly threatening to wipe out billions in paper gains. And now? It is back at $87 and climbing, with a technical target sitting at $120, with 6 consecutive years of supply deficit behind it, and with industrial demand from solar panels, electric vehicles, and AI data centers running at levels this market has never seen before. So the question I want to answer for you today is not just where silver is. It is exactly what needs to happen, step by step, before this market tests $120 again. I am going to walk you through the freshest live data available right now, the structural forces that no analyst can argue with, the critical obstacles standing between $87 and $120, the real risks that could derail this rally, and 3 precise scenarios for where this metal goes next. Buckle up. Let's get into it. Let me start with the numbers, raw, unfiltered, and pulled from live market feeds this morning. Because in a market this volatile, opinions are worthless without data anchoring them. Silver spot price as of 9:48 a.m. Eastern Time today, $87.72 per troy ounce. That translates to $2.82 per gram, or $2,820 per kilogram. In a single year, silver has gained more than $55 per ounce. Let that sink in. $55 of gain in 12 months on a metal that was trading around $32 just 2 years ago. On February 23rd, just 2 days ago, silver surged an extraordinary 4.81% in a single trading session, dramatically outpacing gold for the second consecutive week. The trigger was a combination of softer U.S. economic data and escalating geopolitical tension. Weaker than expected retail sales, a GDP control group reading that actually contracted by 0.1%, and fresh uncertainty around U.S.-Iran relations all hit the market simultaneously. When fear spikes and economic data weakens at the same time, silver does not just benefit, it supercharges. Because it is both a safe haven metal like gold and an industrial metal like copper. It gets a double tailwind from exactly this kind of environment. Now I want to give you the bigger context, because silver's journey to this point is unlike anything in modern market history. On January 29, 2026, silver printed $121.67 per troy ounce, a nominal all-time record. The previous record had stood since 1980, 46 years. Silver had been capped below $50 for over 4 decades, and then in early 2026, it didn't just break through $50, it blew past it, doubled it, and hit $121. That is a market that was coiled like a spring for decades and finally broke free. Then came the crash. On January 30th, a single announcement, the nomination of Kevin Warsh as the next Federal Reserve Chair, triggered a 27% single-day collapse in silver. Warsh is known as a hawk. Markets interpreted his appointment as a signal that rate cuts were off the table for longer than expected. A surging U.S. dollar amplified the move, and silver went from $121 to the low 80s seemingly overnight. But here is what I want you to notice. Silver did not collapse to $50. It did not collapse to $60. It found a floor in the $80 range, and it found it fast. Why? Because at $80, every solar manufacturer, every EV parts buyer, every industrial procurement team that had stepped back from the market when silver was at $120 came back as an aggressive buyer. That is not speculation. That is what actually happened in the physical market. Industrial demand provided a natural, structural floor. And from that floor, we have bounced back to $87, and we are heading higher. Now I want to talk about the most important fundamental story in the entire precious metals space right now. And it is not gold. It is silver's supply deficit. And this is the foundation upon which the entire $120 target rests. The silver market is entering its 6th consecutive year of supply deficit in 2026. 6 years. That means for 6 straight years, the world has consumed more silver than it has produced. Think about what that means for a physical commodity. Every year, the gap between supply and demand has to be filled by above-ground stockpiles, vaults, ETF holdings, industrial inventories. Those stockpiles are not infinite, and they have been drawn down year after year for half a decade. Total global silver supply is forecast to reach approximately 1.05 billion ounces in 2026, a decade high, but representing growth of only 1.5% versus last year. Mine production is expected to rise just 1% to 820 million ounces. And here is the critical structural constraint that most analysts gloss over. Approximately 75% of all silver mined in the world is produced as a byproduct of mining other metals: gold, copper, lead, zinc. That means even if silver prices double again tomorrow, miners cannot simply switch on new silver supply overnight. The silver comes out of the ground at whatever rate the primary metal demands. It is a supply mechanism that is fundamentally inelastic to silver's own price. That is an extraordinarily bullish structural feature that very few commodities share. On the demand side, the picture is even more striking. Industrial demand for silver reached 680 million ounces in 2024, representing roughly 60% of total global silver consumption. And in 2026, that industrial demand engine is firing on all cylinders simultaneously. Global solar photovoltaic capacity is forecast to hit 665 gigawatts this year, requiring an estimated 120 to 125 million ounces of silver just for solar panels alone. Electric vehicle production is projected at 14 to 15 million units globally, consuming a further 70 to 75 million ounces. Grid upgrades and data center infrastructure, the physical backbone of the artificial intelligence revolution, are expected to add another 15 to 20 million ounces on top of that. Let me put those numbers in perspective for you. Solar, EV, and grid demand alone could account for over 210 million ounces of silver demand this year. That is more than 20% of total global supply, consumed by just 3 industrial sectors. And none of those 3 sectors is going away. Solar installations are legally mandated in many jurisdictions. EV adoption is accelerating by government policy across Europe, China, and increasingly the United States. And AI data center build-out is one of the most heavily capitalized infrastructure projects in human history right now. This is not a speculative demand story. It is a technological imperative, and it is running headlong into a supply structure that simply cannot respond fast enough. That is why 6 consecutive years of deficit is not a warning sign. It is a flashing neon arrow pointing directly at higher prices. There is one indicator that professional precious metals traders watch above almost everything else when positioning between gold and silver. And right now, it is sending one of the clearest signals I have seen in years. That indicator is the gold-silver ratio. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, over centuries of monetary history, this ratio has averaged somewhere between 15 and 20. In modern markets, it is traded in a much wider range, spiking to 120 during the COVID panic of 2020 and compressing to around 30 during silver's explosive 2011 run. Where is it today? The gold-silver ratio currently stands at 59 to 1. Gold is at $5,154. Silver is at $87.72. That means you need 59 ounces of silver to buy 1 ounce of gold. Now compare that to 18 months ago when the ratio was above 80 to 1. The compression from 80 to 59 represents an enormous relative outperformance by silver, and it is telling you that the market is already repricing silver higher against gold. But here is what really matters. If the ratio continues to compress toward 50 to 1 by year-end, which several institutional analysts now forecast, and gold holds at even its current level of $5,154, then silver would need to trade at approximately $103 just to reflect a 50 to 1 ratio. At a 45 to 1 ratio, still historically elevated, silver would need to be at $114. The math alone gets you close to $120 without requiring any additional fundamental improvement. I want to be very clear about what this means for you as an investor or trader. The gold-silver ratio is not just a historical curiosity, it is a real-time signal of how institutional capital is flowing between the two metals. When the ratio compresses aggressively, as it is doing now, it typically means that silver is entering a phase of accelerated outperformance. Professional traders watch this ratio the way stock traders watch relative strength, and right now, it is telling them to be in silver. All right, now let's get into the chart, because the title of this video makes a promise, and I intend to keep it. Here is exactly, technically, what needs to happen between $87 and $120. Right now, silver is trading within a clearly defined upward channel on the daily and weekly charts. Short-term support is anchored in the $80 to $84 range, the zone where industrial buyers stepped in aggressively after the January crash. This is the floor. As long as silver holds above $80 on any pullback, the bullish structure remains intact. The first major hurdle between here and $120 is the resistance cluster at $92.70 to $94. This zone represents a confluence of the previous breakdown level from the January crash, a 61.8% Fibonacci retracement of the move from the $80 low back to the $121 high, and a region where significant short positions were established by traders who sold into the January rally. To break through this zone, silver needs a catalyst, either a dovish Fed surprise, a significant geopolitical escalation, or a fresh round of industrial demand headlines. If silver can break and close above $94 on the weekly chart, the next target becomes $100, the round number psychological barrier. $100 is not just a number, it is a threshold. When silver trades above $100 for the first time in history, on a sustained basis, not just an intraday spike, it will trigger a wave of mainstream financial media coverage, retail investor FOMO, and institutional reallocation. That coverage loop is itself a price catalyst. The move from $94 to $100 could be relatively slow and grinding. The move from $100 to $110 could be violent and fast. From $100, the next technical target is the $108 to $112 zone, a region of prior consolidation during the January run-up. Above $112, the path to $120 becomes technically clear. The RSI momentum indicator currently shows moderate buying pressure, not overbought, which means there is room for silver to extend before hitting technical exhaustion. The multi-period moving averages are all aligned in a bullish configuration, with the short-term averages above the medium-term averages above the long-term averages. That stacking pattern, technicians call it a bullish alignment, is one of the most reliable indicators of a market in a sustained uptrend. Short-term price forecasts from quantitative models are also pointing higher. A 7-day projection updated on February 23rd estimates silver could reach $97.95 by March 1st, a 13% move from current levels in less than a week. That kind of short-term projection has to be treated with caution, but it reflects the current momentum and the directional bias of the market's algorithmic positioning. The roadmap to $120 in plain language. Break $94. Consolidate above $94. Target $100. Blast through $100 with media momentum, grind to $108 to $112, and then make a run at $120 when the next macro catalyst arrives. That is the sequence. That is what needs to happen. Now let's look at what the biggest financial institutions in the world are actually forecasting, because the range of opinions here is one of the most extraordinary things I have ever seen in institutional research. JP Morgan has a 2026 average forecast of $81 per ounce for silver. Yes, $81. They are technically already below current spot price. HSBC is sitting in a $58 to $88 range. Citigroup is around $70. These are the conservative Wall Street banks, and they are all already looking at a silver price that is blown past their models. When the biggest banks in the world have forecasts that are already below the current spot price, it tells you one very important thing. Their models are based on historical supply-demand dynamics that have been structurally disrupted by the green energy revolution and the AI infrastructure boom. They are fighting the last war. On the other end of the spectrum, you have Bank of America with a forecast that goes as high as $309 per ounce. $309. Now, I am not saying that is a base case, but the fact that a Tier 1 institution has published a research note with that number in it tells you something important about the upside scenarios being considered at the highest levels of finance. CME Silver Futures Positioning, which reflects the actual money being wagered in the world's most liquid silver derivatives market, is pricing a year-end average of approximately $91.24 per ounce. That is actually relatively conservative compared to the technical targets, but it is well above most bank forecasts. And FX Empire, one of the most widely followed technical analysis platforms in the world, specifically calls out a test of $100 as likely in 2026. The US government has also added silver to its official list of critical minerals. Think about what that means. Critical mineral designation means strategic stockpiling, supply chain investment, potential import protections, and government-level demand that operates completely independently of price. The U.S. government is not buying silver because it is cheap. It is buying silver because it needs it. That is a category of demand that does not appear in any bank's demand model, and it is structurally bullish in a way that price alone cannot capture. I would be doing you a disservice if I only told you the bull case. So let me give you the honest risk picture, because silver is one of the most volatile assets on the planet, and the risks are real. Risk number one is the Federal Reserve. Markets are currently pricing in approximately 60 basis points of Fed rate cuts by year-end 2026. If that expectation gets walked back, if inflation proves stickier than anticipated, or if the new Fed Chair Kevin Warsh signals a more hawkish stance than markets expect, real yields could spike. A spike in real yields would strengthen the US dollar and create a significant headwind for silver. The January crash showed exactly how fast and how hard silver can fall when dollar sentiment shifts. A repeat of that scenario is not impossible. Risk number two is demand destruction at high prices. JP Morgan's head of precious metals strategy, Gregory Shearer, has specifically flagged that if silver prices return to the $120 range, solar manufacturers may accelerate their adoption of silver-free alternatives, specifically cadmium telluride thin film technology. There is also a practice called thrifting, where industrial users engineer their products to require less silver per unit. Both of these dynamics are real. They take time to implement, but they represent a genuine long-term ceiling on how much industrial demand can be sustained at very high price levels. Risk number three is the speculative overhang. Part of silver's January rally to $121 was driven by speculative activity, and according to U.S. Treasury Secretary Scott Bessent, Chinese traders played a significant role in amplifying that move. Speculative demand can evaporate overnight. It does not have the structural permanence of industrial demand or central bank buying. If speculative positioning gets extended again near $100 or $110, the risk of another sharp washout is elevated. That is something you need to monitor closely in the Commitment of Traders report. Risk number four is liquidity. The London silver market, which is the world's primary over-the-counter silver trading hub, has experienced periods of relatively tight physical liquidity in 2026. During the January spike, lease rates jumped over 30 times their normal levels. That kind of stress in the plumbing of the market can amplify volatility in both directions. In a crash scenario, illiquidity accelerates the move lower. In a rally scenario, it can trigger short squeezes that push price far beyond fundamental value. Volatility in silver is going to remain a defining feature of this market for the foreseeable future. Plan accordingly. Now let me give you the three forward scenarios I am watching and tell you which one I think is most likely. Scenario 1. The bull case. Silver breaks $94, tests $100, and targets $120 by Q3 2026. In this scenario, the Fed turns dovish earlier than expected, perhaps triggered by further weakening in U.S. economic data. Real yields fall. The dollar weakens. Industrial demand data for Q1 2026 comes in even stronger than forecast. ETF inflows surge as retail investors, who largely missed the move from $32 to $121, pile back into silver on fear of missing the next leg up. The gold-silver ratio compresses to 50-1 or below. Physical silver lease rates in London remain elevated, signaling tight supply. Speculative positioning builds gradually rather than all at once. Under these conditions, silver breaks $94 cleanly, consolidates between $94 and $100 for a few weeks, then punches through $100 with media-driven momentum and makes a run at $120 before the end of Q3. This is the scenario that JP Morgan's bull case, Metals Focus's $120 target, and the technical roadmap all point toward. Scenario 2, the base case. Silver consolidates between $80 and $94, tests $100 by year-end 2026. This is the scenario I assign the highest probability to over the next 6 to 8 weeks. Silver is digesting an enormous rally, from $32 to $121 in roughly 18 months. Markets need time to consolidate after moves of that magnitude. In this scenario, silver oscillates between $80 and $94 for several weeks, building a solid base of support. The supply deficit continues to tighten available inventory. Industrial buyers accumulate steadily at lower price points. The Fed holds rates but softens its language by mid-year, giving silver a push toward $100 in Q3 or Q4. The move to $120 becomes a 2027 story rather than a 2026 story. This scenario is constructive and ultimately bullish. It just requires patience. Scenario 3. The bear case. Silver retests $72 to $78 before recovering. If the Fed turns hawkish, the dollar surges, and geopolitical tensions de-escalate simultaneously, silver could face a significant secondary correction. Industrial demand at high prices begins to show signs of thrifting. Speculative longs exit en masse. In this scenario, silver breaks below the $80 support zone and tests the next major support level at $72 to $78, which represents approximately a 50% retracement of the entire post-2024 rally. This would be painful for recent buyers, but critically, the structural story would be unchanged. 6 years of deficit does not disappear because of a Fed announcement. If silver hits $72, I believe it would be one of the greatest physical buying opportunities of the decade. Let me give you my honest perspective, and I will preface this by saying clearly, nothing in this video is financial advice. I am a market analyst. Your investment decisions need to be made based on your own financial situation, and ideally with the guidance of a qualified financial advisor. With that said, here is how I think about silver at $87. The structural case is among the strongest I have ever seen for any commodity. 6 consecutive years of supply deficit. Industrial demand that is structurally non-discretionary. A gold-silver ratio that is compressing and has room to run further. Government critical mineral designation creating sovereign demand. Physical investment demand recovering strongly after 3 years of decline, up a forecast 20% to 227 million ounces in 2026. And a market that just demonstrated it has real industrial buyers who step in aggressively at $80. That is a powerful combination. At $87, silver is not cheap in absolute terms, but relative to where its fundamentals point, $120 on the medium-term technical target, with institutional forecasts ranging up to $309 in extreme scenarios, it is not expensive either. The question is not whether to be in silver. The question is how and at what price. If I were structuring a position today, I would not chase the current move aggressively. I would wait for a pullback toward the $82 to $84 support zone, which I think is entirely possible given the resistance at $92 to $94, and build a position there with a clearly defined stop loss below $78. A break below $78 would tell me the base case has shifted to the bear case, and I would want to be out and waiting for the lower support level around $72. If you are already holding silver, hold it. The medium-term trend is your friend. Use pullbacks to add, not panic. And keep your eyes on the $94 level as your first major confirmation that this rally is resuming in earnest. Let me bring everything together for you. Silver is at $87.72 today, February 25, 2026. It hit an all-time high of $121.67 on January 29th, crashed 27% in a single session after the Kevin Warsh Fed chair nomination, and has been recovering aggressively ever since, supported by industrial buyers who stepped in at $80 and have not let go. The structural foundation for higher prices is ironclad. 6 years of supply deficit. Mine supply that cannot respond to price signals because 75% of silver is a byproduct of other metals. Industrial demand from solar, EVs, and AI data centers that is structurally non-negotiable. Physical investment demand recovering 20% in 2026. Government critical mineral designation. And a gold-silver ratio at 59:1 that has substantial room to compress further. The roadmap to $120 runs through $94 first. That is the key level. Break $94 and hold it, and the next stop is $100, a psychological threshold that will generate mainstream media coverage and a new wave of investor interest. From $100 to $120 is where this market has the potential to move fast. But it requires patience to get there, discipline to manage the volatility along the way, and a clear understanding of the risks. A hawkish Fed, demand destruction through silver thrifting at high prices, and the ever-present danger of speculative excess creating another violent washout. I am Alex Morgan. I track this market every single day, and I will be bringing you updates as the key levels are tested and the story develops. If this analysis added value to your understanding of the silver market, please subscribe, because the next chapter of this story is going to be one you will not want to miss. Drop a comment below right now. Are you holding silver? Are you thinking about buying? Or are you on the sidelines watching? I read every comment and I want to know where you stand. Until next time, stay sharp, stay disciplined, and I will see you in the next video.